Michael Burry has done it again. The legendary investor, famous for predicting the 2008 financial crisis, is making bold moves in the stock market, moves that have caught the attention of investors worldwide. He has just sold over $70 million worth of his U.S. stock holdings, a decision that is eerily reminiscent of his actions before the Great Recession. So why is Burry making this drastic move? What does he see that others don't? And more importantly, where is he putting his money instead? Let's break it all down. The U.S. stock market is on fire. We are witnessing one of the strongest rallies in history, yet Burry has been aggressively selling. In his latest filings, he completely exited 14 different U.S. stocks, selling over $70 million worth of assets. Earlier in 2024, he even offloaded all his positions in major tech giants like Amazon and Alphabet. And so far it looks like he left money on the table, as these companies have been among the best performing stocks of the year. But Burry isn't afraid to go against the crowd. He's not looking at short-term gains, he's concerned about risk. And when we look closer at the data, his concerns start making a lot more sense. One of Burry's biggest red flags? Valuations. The S&P 500's price-to-earnings ratio is at levels we haven't seen since the late 1990s. The last time the market was this expensive, it was the peak of the dot-com bubble. And when that bubble burst in the early 2000s, investors lost fortunes. The only other time valuations were this extreme was in 2021, right after the pandemic, when stimulus money flooded the market and interest rates were near zero. Today, we're back at those dangerous levels. But it's not just high valuations. Market concentration is another major concern. Right now, 4 companies, Amazon, Microsoft, Nvidia, and Apple, make up 25% of the S&P 500. This means the entire market's performance is heavily dependent on just a few stocks. Think of it like a table with only a couple of legs holding it up. If one of those legs breaks, the whole structure collapses. And when we look at history, we see that today's concentration is even worse than during the dot-com bubble. The risks are undeniable. So, if Burry is selling out of U.S. stocks, where is he putting his money? The answer? China. In the third quarter of 2024, he made a massive shift towards 3 major Chinese tech giants, Alibaba, JD.com, and Baidu. He increased his stake in Alibaba by 29%, bringing its total value to $21 million. He doubled down on JD, pushing his holdings to $20 million. And he grew his Baidu stake by 67%, reaching $13 million. Together, these investments now make up nearly 1/3 of his entire portfolio. Why China? Simple, low valuations. While the US market is sitting at dangerously high levels, China's market is historically cheap. Right now, the P/E ratio of China's stock market is just 10.2, one of the lowest levels seen since 1996. Investors remain highly pessimistic about China, but this means it could be an undervalued opportunity. Of course, China's market isn't without problems. The country has been struggling with poor economic growth, a troubled real estate sector, and weak consumer demand. In fact, consumer confidence is at its lowest levels since the 1990s. If people aren't confident in the economy, they're more likely to save than spend, which slows down growth. These factors have led the Chinese stock market to drop more than 60% from 2021 to early 2024. But the Chinese government isn't standing by. They've announced multiple rounds of stimulus in 2024. In January, the central bank cut reserve requirements, injecting $140 billion into the economy. In September, they rolled out a $110 billion market support plan. And in October, they went even bigger, a $1.4 trillion package to be deployed over the next 5 years. This bazooka stimulus is a clear sign that China is willing to do whatever it takes to boost growth. But here's the interesting part. Burry isn't just betting on China's recovery, he's also protecting himself in case things go south. In the third quarter of 2024, he hedged his entire China trade with put options. For Alibaba, he bought puts covering 169,000 shares valued at $18 million. For JD, he hedged his full position with puts on 500,000 shares. And for Baidu, he purchased puts on 83,000 shares worth $8.8 million. In total, these hedges add up to $43.6 million, covering nearly 80% of his China trade. Burry may also be preparing for another factor: US-China relations. With Trump's recent political developments, trade tensions could escalate again, negatively impacting Chinese stocks. By hedging his positions, Burry is ensuring that if China's market takes another hit, he won't go down with it. So what's the takeaway? Michael Burry sees major risks in the US market: high valuations, extreme concentration, and limited upside. That's why he's cutting exposure and shifting towards China, where valuations are low and government stimulus is strong. But he's also hedging his bets, ensuring that if things go wrong, he's protected. This is classic Burry: bold, contrarian, and calculated. Will his strategy pay off? Only time will tell. But one thing's for sure: when Michael Burry makes a move, the world pays attention.